Interest rates are going up again in just 2 weeks, but the question is, by how much? A new jobs report released last week will give the Fed more data to answer that question. So the report I'm talking about is the August jobs report. Experts called it a Goldilocks report, not too hot and not too cold, which is the direction the Fed wants to see. So that's good. But overall, the report shows the U.S. labor market remains super strong. And the Fed chair has said instead of it being super strong with lots of open positions and not enough people to fill them, he wants to see the labor market cool off without sending a ton of people to the unemployment line. Now, here's what was in this Goldilocks August jobs report. The labor market added 315,000 jobs, which is good, but it's certainly not as good as it was in July when the labor market added 528,000 jobs. Unemployment is still near a 50-year low, which is good, but August's unemployment rate was slightly up from July. It was just 0.2% more, but still, that's up. The report also found wages are up, the number of Americans who are participating in the workforce is up, and the number of women back in the workforce is up. All good. So next week, we'll get the Consumer Price Index report, which is a good indicator of what's happening with inflation. Now, these two reports, plus the same reports from last month and the quarterly GDP report, will give the Federal Reserve a good picture of what's happening with our economy and how their past interest rate hikes have impacted inflation, if at all. The Fed could raise interest rates again by either 0.5% or another drastic 0.75% when they meet on September 20th.